Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Succession Planning for Florida Accounting Firms. Before we begin, let's cover a few important items. First, please close any other programs that you have running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. First, you must participate in all 3 of today's polling questions. Please note that GoToWebinar does monitor your participation in the polls. Next, you'll also need to complete an online evaluation. It will appear on your screen immediately following the webinar, so be sure to complete that before you close your browser. Once both of the requirements are met, the CPE certificate will be emailed to you within 10 business days. Now, in order to fully participate in the webinar, please take just a moment to familiarize yourself with GoToWebinar. The control panel should be on the right-hand side of your screen. There's an orange arrow at the top that will minimize the control panel. And during today's presentation, all of the participants will be muted, but you can communicate with us by using that question box that's towards the bottom of the panel. Just type any questions that you may have and click send. Time permitting, Marcia will answer all of your questions at the end of the presentation today. Finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. Our upcoming topics include internal succession readiness assessments, which is taking place tomorrow. There's still time to register for that. In July, we have valuing accounting firms, and then in August, growing your firm through new practice niches. You can view a list of these and all of our other webinars, including links to register for them, at the CPE courses section of transitionadvisors.com. Now, just a quick reminder that you received a reminder email from me, and in that there was a link to download today's presentation. I also just sent it to you via the chat function of GoToWebinar if you'd like to download that PDF and follow along. And now I'd like to introduce our presenter for today. Marcia Miller is the Managing Director of Transition Advisors. Thank you so much for attending, and we hope you enjoy today's webinar.
Thanks, Nikki, and good afternoon to everybody. Boy, this is great today. I'm in sunny South Florida, and I know you're all in the Sunshine State. Hope the weather is good for you. I did notice there are a couple people on the call that I know personally, so I'll say a personal hello to you, and hope to meet or speak to the rest of you in the near future. So let's get on with our presentation today. Before we do, I just want to tell you today we're going to talk about succession planning for mainly Florida accounting firms and the market here. But I want you to know, if you're thinking of succession and you find your own succession by yourself, Transition Advisors can offer a multitude of services to help you go through the deal, sort of what you're going to see in the next few slides as we go along. Now, there's something that everyone always says. If there are 50 things you need to think about in any transaction, the smartest person in the room is only going to think about 35. There are so many different vehicles that we have to look at, but when you go through this with me today, it'll make you more aware of the things that you may want to do in your succession planning. One of the biggest questions that I'm asked as I travel around Florida, and also I'm in Georgia, is it a buyer or seller's market? And you know what? A lot of times I have to say depends, because my sellers in South Florida, whether it's Fort Lauderdale, Palm Beach, is going to be totally different than someone who's in Naples or Tampa. Location is really, really important. Another thing, you have to look at size. What's your size if you're the one who is looking for a successor, or if you are one who is looking to acquire someone who is in that mode of succession. You got to look at the size. You got to make sure it's going to match with what the other partner has. Also, you want to look at the density of population. There's a city above Orlando that it has no population at all. I guess it's a bunch of groves. It's very hard if you have a lucrative practice there to have someone who's larger than you to go to that area. So, the metropolitan areas have a better chance of having these mergers work. I'm not saying they don't work, but it depends because, if you're out in the boonies, the supply and demand is really very different. Something we're seeing today is niches that various firms have, whether it's in the international realm, whether you have real estate clients. I have someone who only has dental clients in his practice. So, of course, you got to see if there's somebody in the market who has something like that. Or maybe another firm's going to say, oh, my God, I never thought of this niche that it even exists. I would love to have that as part of my practice. I just got off the phone with someone today who bought a tremendous practice, and I asked, it was a $5 million firm, so it was big, merging into a much larger firm. That's what we call the upstream merger. And I said, well, did you have room in your office for all their staff? And the firm that was acquired was totally virtual, and they hire a lot of employees. It was actually around the country that all these virtual employees are. And that's what we have today. It's a totally different market because of the cloud and because of virtual working and the like. Now, here's a couple of statistics. I don't like to bog down with too much, but I thought these are the most important ones that you'd want to know about. 80% of multi-owner firms expect to go through succession planning, and it will be the most important issue over the next 10 years. Less than half of the multi-partner firms in the U.S. have mandatory retirement guidelines. That's something also that enters into the mix. I have one seller who says, I want to work till I die. A lot of people say I'm going to die at my desk. And some people say, well, I'm 66 now, but I think I got a good 10 years left. Well, if you go to somebody who already has this mandatory retirement plan, that may not work. So you have to find the right firm for that mix. 61% of firms or partners, equity owners, are now over 50. 46% of multi-owner firms have a formal succession plan in place. So there's a lot of people, maybe some of you on the call, who don't have that plan in place, and I'll be glad to help you with that. Firms with less than 15 employees, 70% of those firms do not have a succession plan in place. And when we're talking about less than 15 employees, of course, you're talking about a lot of sole proprietors, and that's why you're seeing this as well. And then less than 6% of the sole practitioners have a PCA, a practice continuation agreement. And that's just that you have another CPA who is available should something happen to you. They'll know the codes to get into your computer. The practice can go on. Last summer, I had someone who unfortunately had a heart attack, and he didn't have another CPA that had that PCA, and that created a problem because the person was disabled due to that medical event. And we never know in life what's going to happen and when. So the next question I'm usually asked is, when are we going to start this process? Well, you know what? It actually will start probably the day you open up your practice, because when you open up your practice, you want to know later on, am I going to grow, or am I only going to work till retirement age and then walk away? And who's going to take over? I'm growing this thing. It's going to have a value to it. Like you have a house and the market value goes up. If your practice grows over a year, it's going to have a value because you've gotten all these clients, maybe one at a time, maybe through referrals, maybe after 10 years of practice, you got into the niche of, let's say, forensic accounting. I know that there are a lot of people, a lot of CPAs doing that now. That's a very big niche. Of course, another niche is, of course, the financial or wealth management niche. So those are ways that firms grow. But what we're seeing today is the merging or acquisition of another firm. And we're seeing that is one of the biggest types of growth today. And if you look at some of the top 100 firms, you'll see that if you go to their history, you'll see only a few days ago they were maybe 1/4 the size, but they did all these large acquisitions, one after another, and that's what allowed them to grow. Now, there are certain types of mergers. There's what we call a mini merger, and that's just adding 1 or 2 partner firms with their books of business. The upstream merger that I alluded to a moment ago, but those mergers could have, depending on how many partners you have, it could involve 3 different types of deals within one. Perhaps there's a partner who's already 70, he wants the immediate sale. Perhaps we have the 2-stage sellers. I know a lot of you know about that, but I'm going to go into that in more detail later on. Or perhaps there's a merger for partners not seeking succession or role reduction for more than 6 years. I have one right now. One partner wants to leave in 2 years. 2 partners are going to leave in 4. And then there's not the junior partner, but a person who's the audit partner is only 45 years old, so that partner is going to be there far longer. So in these mergers, you can account for all these different things. You'll also account for what equity each one of these partners coming into the firm will have. Sometimes they're non-equity partners, but they may be named a partner of the firm, depending on the deal. And you may have look-back periods as in your agreement. And demergers we don't see that much of. If you do the deal right and you look at some of the things that we suggest, that probably is not going to happen to you. And you don't go into these mergers when you're going on in years thinking it's not going to work out. It's not like when you were 20 years old and you were dating and you wanted to test the waters. This is a little different. This is to close the book on your workplace in your life. I'm not saying totally. You could scale back. Maybe you're working 2,000 hours a year and you want to work 1,500. I have one client who recently sold his practice here in Florida, actually in his 70s. And that's why I say he's actually 75 right now, and just sold his practice a couple of months ago. And I said, well, now what are you going to do? And he says, well, instead of my getting up, going to work, and staying here till 12 o'clock and going home, I'm now going to go home at 6 o'clock and have dinner with my wife. That, to me, is retirement. I don't know, maybe he'll get used to working a couple of hours less and not on all the weekends, and hopefully he'll have a better quality of life and I hope a lot of good health as well. So anyhow, something else we want to look at when you're looking at mergers, you want to look at the characteristics of the partner that's coming in. And we have a couple of items here listed. I don't want to go through all of them, but there's something that's really important when you're looking at the partners. Does that partner have the ability and desire to bring in new business? We put in our agreements a new business incentive for those people. And you know, there are certain people that say, all I want to do is be the rainmaker. I can bring more, I can grow this business. If I don't have to do the grunt work, I could bring you a lot of work. And if you go in when you're doing your due diligence, if you find out what that person has done or those partners that do it, you'll know whether the firm that you're bringing in can even blossom even more. You want to know that they have good relationships with their clients. A lot of our clients are almost like our family. You were at their, maybe you were at their wedding. Maybe you were there when the first child was born. Maybe you went to a graduation. Maybe you went out to dinner with them a lot. If you have that kind of relationship with your partners and your firm now, and you're looking for this succession, You want to know that whoever you're going to merge with is going to have that same outlook toward life. And you may want to know how they handle the administration of their firm. You may want to, you do your own checking up on that person. Maybe you know them through the industry and through certain associations that you're affiliated with now, and maybe some of these have been answered. Like the person I spoke to this morning that bought the $5 million firm, they said they've actually known this person for over 20 years. And they finally came to them and said, we need a succession plan. And we've known you for years, and we know all about your firm, and we want to know if there's something we can do. So there are all different ways where you're going to have succession. But here's some of the characteristics of our partners. Now, again, I said, when do we start? Probably the day you start your business, because you want to know how many more tax seasons do you want to work. You want to evaluate how much face time there is. I've had my own practice for 35 years. Back 35 years ago when I started, I would go to the client, I would do the work, I would pay the bills, I'd even write out my check for the services for the day. It's kind of different now. Yeah, you could get on a Skype call with a client, and that's often done, but now our FaceTime is very different with the phone, the fax, and the emails. And my God, do I have emails. And 5 different email accounts, and it drives me a little crazy. But anyhow, the FaceTime is down. There was one client I went to on a weekly basis, then it went to a monthly basis, then it went to quarterly, and now I see that client every 6 months. I'm not saying I don't talk to the client very often, because I do a lot of hand-holding, Liz, which a lot of us do with our clients, but the FaceTime is not there anymore. Some of the things you want to think about, maybe you were deciding to invest in other kinds of technology, get a lease on another property. Maybe you need more staff, for that additional work you brought in. Well, if you merge, you may have all that for you. You don't have to reinvent the wheel. Maybe they've gone through it already. Maybe that other firm has excess capacity in their staff that can help you with your firm, your niche, whatever it may be. But once you do start the process, you should begin it 5 to 7 years out. You know, it's kind of hard if you do it, if you wake up today and say, I want to sell tomorrow, that's not that easy to do. So you want to have a couple of years to think about this. And the supply of sellers is expected to increase. And if it does, multiples will drop. And the multiples in Florida right now, Florida is a little different than some of the places in the country. We're looking about a one-time multiple, but it'll also depend on how long the seller wants to stay on before moving on or slowing down. So multiple are, it's a tricky question to answer. Every situation is going to be different. Now, what if you're a procrastinator and you put off your succession? What can happen? Well, a lot of bad stuff can happen. Firms that wait too long to begin this planning find that they have 2 options. They may be arranging a merger with unfavorable terms to them, or maybe they're just going to walk away and say, okay, I'm done. I don't even care. I don't want anything from my practice. I'll just drain it dry and I'll leave. And those firms that are not proactive will surely create the client and real estate opportunities for the other practices around the corner. And we all know how much competition we have today. So here's a study of the high cost of procrastinating. This was a practice of a sole proprietor in, I believe, in the New York area, who put off finding a successor. And in the interim, these are the things that happened. A key employee resigned. One of his large growing clients suddenly became at risk because they didn't need services a sole practitioner didn't offer. Another reason why we, like that firm that I just told you about, bought the $5 million firm, they did that to increase the niche. they couldn't offer it. Maybe the aging IT of this person needed a comprehensive and expensive upgrade. Why not do it with the firm that you're going to merge into? In this case, the owner was open to any offer that came along instead of managing the process in an orderly fashion. I mean, wouldn't it be better to have a choice of firms out there instead of being desperate? It's like when you're going to sell your home and maybe you priced it wrong, so nobody's looking at it. And now you're running out of time because you're moving somewhere else into another house, so you have to slash the price. You give up a lot just because you're desperate to sell. You don't want to sell in desperation. You want to give it a lot of time. You want to give it a lot of thought. So here are some of the questions you may want to ask each year. Have any of the partners' career or retirement goals changed over the past year? Do we have any partners who want to reduce their time commitment and look over the next 5 years regarding that commitment? Do we have any critical staff closing in on retirement? I have a client right now. One of the problems in doing the merger for him is he's got staff that are older than he is. So they won't stay on to work on those clients. So we have to make sure that the successor firm has that capacity. Another question is, have any new partners been admitted to or left the firm? Do any of the above questions require changes to your current succession plan? So these are some things you want to consider. Some other things, we mentioned the niche. Maybe you want to have a location on the other side of town. For you, those of you on the call from the West Coast, maybe you want to have it over the Tampa Bay Bridge. Some people say that to me. Yeah, I want to be on the Tampa side and the St. Pete side. I want to have an office in both places because it's very inconvenient for my clients in St. Pete to come to the Tampa office. So I'm looking to have another satellite office, if you will. Have you had a gain or a loss of any large clients? Or with that comes a change in revenues? A downturn or upturn in the economy. We all remember two major functions. First, 9/11, a lot of people stopped working because they didn't know what was going on. And then we had a downturn in the economy in 2008, so we had a lot of financial problems, so a lot of closures in that regard, and a lot of real estate was gone down so much, so you lost all those real estate partnerships and the like. So, but we never know when this is going to happen. What we certainly don't know is a sudden loss of a partner or staff. Maybe it's a resignation or death or disability. I just spoke to someone this morning who wants to talk to me but is so stressed out because their administrative assistant had a life-threatening illness that just got diagnosed. They had surgery, and we don't know what the result of that will be. We never know what's going to happen. So be really concerned about your practice. It's your baby. And Nikki, we have the first of our polling questions. There'll be 3, and we want to make sure that you not only learn a lot today, but you get your free CPE credits. So let's start with poll number 1, please.
Sure. Poll number 1 should be on your screen. The question is, how many partners are in your firm? So I'll give everyone just a few more seconds to indicate their answer. Okay. Looks like everybody's already answered, Marcia, and everyone on the call today is in either a 1 or a 2 partner firm.
Okay. So we have mainly sole proprietors here. Okay. Like myself. Just myself and my son. So, okay. Let's go into some things, how you should choose your successor or target firm, as we call it, to either acquire or merge. First of all, you want to know, is that successor ready? You're going to meet with them. You want to find out from them why they want to merge or why they want to acquire. You're going to ask the questions about their staffing. Can the staffing take on the burden of your practice? If you're a 1 or 2 man operation, perhaps you only have 1 or 2 in staff. I don't know. I do know one client that I have that's a single owner, but it happens to have 40 people on staff. That's remarkable, but he's got very good staff people on there. They're more managers than anything. But you want to know if you're going to another firm, you're going to upstream merge, or you're going to work on your succession plan, do they have the staff to take over as you are slowly weaning off all those extra hours? Do they have the real estate? Excuse me. Is there physical space for everybody, or are you really going to have a lot of cubby holes? You'll ask about technology and equipment. You know, a lot of us are starting to go into the cloud. I know myself included. It's hard to teach a new dog new tricks, but I am obviously one of the baby boomers. But there are a lot of people who are only in the cloud, that they're only virtual. So it makes it hard when you're looking at someone who wants a succession plan. Will they agree to be totally paperless? I don't want to have file cabinets anymore, is what the successor is going to say. I want it all in the cloud. So those are certain things you have to look at. And you want to know that your successor has the financial strength to take on your overhead as you're doing the transition. Now, also I say bigger is not always better. Yeah, it's great to be with a big firm, but some people are scared of the big firms. So you could actually merge with someone who is just slightly larger than you. You obviously would not want your successor to have less in revenue than you do, only because they may not have the capacity to take over all your client issues. So there's a lot of things you want to look at. Now, when you are selecting your successor, look at the specialties or the niches they have, how large they are. Ask them about their retention rates and, of course, the excess capacity. Billing rates are important. You want to make sure that they're not going to scare your clients away because your billing rate is so much lower. Locations, the location is going to be important to you as well as the clientele you have. And culture, that's one of the 4 C's that we'll look at, and that includes the difference between being brand loyal and partner loyal. One firm concept versus just eat what you kill. Now, when we're talking about brand loyal versus partner loyal, for those that are 1 and 2 practitioners, those clients are normally partner loyal. They're there because of you. Yes, you may have a staff working on their work, but they know you're there and they depend on you to oversee their books and records and taxes. When we're talking about brand loyal, we're talking about the big 4 or maybe the top 100 firms around the country. So that's the difference in culture. So I think we went through a couple of these on how to select your successor. I'm just giving you a list here. One thing that I'm finding in South Florida especially, and for those of you here, you know what I'm going to talk about, we have a lot of firms that are mainly Latin, and they make it a prerequisite. They may speak better English than I do, but they make it a prerequisite because of all of their clientele that all staff have to be bilingual. Well, if you're thinking of doing a merger with this firm and you have staff that are not, it could be a problem. So that's something you may want to look at also. Then you may want to know, as a seller, what, if you are the seller on the call, I don't know if we have sellers or buyers, what you may be thinking is, can somebody really replace me? Or how about the person who says, if I retire, I'm going to die? My clients need me. They depend on me. They have for years. And the biggest one is the seller who says, I'm the master of my own domain. And that's quite common. Some things you want to look at when you are looking at practices, or even if you are the seller and you want to give information to the acquiring firm, they're going to want to know about your billing information, the accounts receivable that you have, the aging of it. They're going to want to know, how are you billing? Do you have retainers? Do you have a combination of time and billing and retainers? That may be contradictory to the way you're doing it. Today, one of the other ways of billing is now value billing, or maybe billing in dollars. These are all the different ways of billing, and you want to make sure that whoever you're going to merge with is doing it the same as you are. And on those billing rates, you know what your profit is on it, just like they know what the profit is. And when it comes to billing rates, if you merge with someone, it's possible billing rates are different for partners, but if they have excess capacity in their firm, they will take someone, let's say that they're billing out at $150 an hour to do your work that you were doing at $350 an hour. That's how you could leverage and make more money, by using that kind of staff that you would get in this type of merger. Other things you want to consider. What assets are there? Do you have to acquire new computer equipment? Is it there? Don't be locked into a lease or the location. Maybe you should be a satellite. Look at the staff that is either going to join that firm or not. And they may not be joining due to the location of the other firm. Or maybe it's a case of, well, I was going to retire anyhow. If you're going to retire in the next 2 years, I'll tell you what, I'll retire now. I won't move with you. That's very common. You may want to participate in future growth. That would be from fee increases from services you had from prior, or for new services, increases for referrals, or like I said before, the new business incentive clause, which allows the seller to remain on as the rainmaker, as we call it. And in a lot of larger firms today, there are managing partners who all they do is deals, mergers, they're the rainmakers. They never look at a tax return all year long. So if you are in that category, you would have a new niche to do in your semi-retirement. I have one client who said, I want to acquire this practice, and I told the owner, listen, you don't have to work a day in your life. I will give you a desk. It'll be here for the rest of your life. All I want you to do is to go to lunch and go to dinner and network with people and bring in the business, because he saw the guy do it and grow a several $million-dollar business. He said, I want you to do that for me. So there's all different reasons and different positions you may have with this new firm. Now, there are ways to structure the transition of a practice through external sales. Maybe it's a straight sale. Maybe you'll have a buy-in that's for a larger firm, a buy-in to buy out, so you have equity in there. And to buy in, I'm not saying write a check. Perhaps you're going to contribute your WIP and your AR. That's a way to buy in. Buyer may or may not bring clients into the newly combined entity. You'll have to work that out, what you're going to share in. A lot of mergers are such that, okay, as of this date, those are the clients that we'll consider in a basket that belongs to all of us. So that's what that means. Perhaps you'll have a merger or a buyout. Then we have something that's unusual that a lot of people want to do. It's sometimes quite difficult. It depends on the firm, and that's the culling out of clients. For example, I have a client who does some property management work, and then also does tax work, which is very lucrative. Property management work, if you have clients in that area, you know it's not that lucrative. And for her to sell her practice and someone to buy that, they really don't want to work on property management. It takes a specific kind of CPA who wants to do that. These HOAs can be a nuisance, but they are lucrative for other CPAs. So it's been suggested, call that out and just sell your tax practice. And that's what carving or calling out means. Or we have our two-stage dealer, which is where you sell your equity, but you stay on for a while. And it's actually less exposure for the seller than options number 2 or 3. Now, the two-stage deal, which is something a lot of people look at, and one of the reasons they're looking at that is that it's a way that the owner, the seller, can be whole in income in the first stage, whether it's 1, 2, 3 years, and then the buyout starts after that. That's when they go and cut back their hours. And so there's a shift in planning in the two-stage deal. And in this two-stage deal, like I said, the seller still makes the same amount of net as they had before. The successor is going to take on all the overhead costs. It's all figured out and agreed to in the beginning. The seller is paid on a percentage of gross collections from the original clients. This is a good thing because the buyer doesn't have to go and pay $1 million for this practice in cash or get it financed, which you were able to do before. Now the banks are reluctant to do that. You're paying the seller that same percentage they were getting on their gross collections prior. So he's happy. He's getting what he got before. And the buyer's happy because they have enough meat on the bone to pay the overhead and to pay the seller. And they have the seller there in stage 1 to work with clients to assure that there's a good transition, and that's really important, that you want that transition to work well. You want the clients to feel comfortable with the new firm. So having the seller around longer will promote that. That's a very good thing for you to do. And here are some of the advantages of the two-stage deal, and I have to say the number one, probably if I was going to put this in order, I'm going to say it's the higher client retention. You'll get more dollars out of it. Here's the advantages to the buyer. There are certain things the seller was paying for. Let's take like labor. Maybe you have that excess labor. I have a client who says, I don't want to fire these people. He says, I lost a couple of big clients, but these staff are so loyal to me. Find me another firm so I can, I as a buyer will be able to keep the staff here. And then I can grow and give more services based on the firm that I get. Perhaps the buyer is using the same software as you are, so you don't have it was included in your costs. They thought it was going to be overhead, but now you're both on CCH or you're both on Thomson Reuters, whatever it may be, so you save there. Maybe you'll save on a master policy for your insurance needs. So those are some of the things in stage 1 that are an advantage to the buyer. In stage 2, you have to determine when that stage 2 is going to begin, and it all depends maybe on the age of the seller, the wants of the seller, and it's all things we'll discuss. The retention period commences after. You have to determine if the seller is going to stay on. Do you pay him a portion of his billable hours, or how are you going to compensate him for that? How are you going to compensate that seller for new business development in either of those stages? And then, of course, you want to determine what's the multiple. And the multiple will also be driven by the number of years that you decide to have this process go through. And now we have polling question number 2. So, Nikki, will you do that, please?
Sure. The polling question is on the screen now. Which best describes your personal situation in the next 5 years? And here your options are that you're seeking to reduce your time commitment, you have partners seeking to reduce their role, you're interested in acquiring a firm, or none of the above. I'll give everyone about 10 more seconds to indicate their answer. Just keep in mind you have to do all 3 of the polls in order to get your CPE credit. Okay, Marcia, I've closed the poll. Once again, we've got unanimous answer here. 100% of the folks on the call are seeking to reduce their time commitment over the next 5 years.
Okay, wonderful. So we have everybody's in common. Too bad we can't see each other around a table. Okay, well, here's what we call our roadmap from start to finish. And I'll go through this briefly. There are 7 steps in every deal. What we suggest is and we have, be glad to go over it with you. Some of you have already gone over this. You'll have a generic practice information sheet. And on that, we're going to give you a number. We wouldn't have your name on there. And it will tell certain key things about you. So you could give this to a prospective buyer, and maybe you don't want the buyer to know it's you, and that's why you would use transition advisors as we will sell you to that buyer, but we'll not disclose who you are because it's a very personal thing, and maybe you're not going to want to have that buyer know that you're out in the market looking to merge or cut back your hours. So we try and make it as secretive and private as we possibly can. But you also have to, in a cover letter, say what your must-haves are. Are you able to leave where you are, or are you going to have to have a tenant in your real estate, which kills a lot of deals? Or do you have to retain certain staff? Sometimes a person who's looking to sell or cut back their time, they'll say, well, I have a great staff and well-appointed offices, but the staff don't have to necessarily stay. If that be the case, and that may be the seller who has staff that are older than he or she is, but if that be the case, then like my other client who's got all this excess capacity, it may be great when they read that, okay? Have an initial meetings with the prospective merger candidate and narrow the field of who you want to go on with and share a non-binding offer. This offer, after the first meeting, just puts down in writing everything you discussed at that meeting. And when you put it in writing and both sides look at it, if they agree, yes, this is what we said at lunch yesterday and we want to go forward, fine. But do it up front, because if there was something in that non-binding offer that you didn't agree to, then what you would see is the deal's going to fall apart and you're just going to, why have more meetings? Don't waste time. There may have been someone else out there that was the ideal partner for you. Perform your due diligence. We talked about some of those things, and close the deal. So these are some of the things that we suggest that you do. I think it'll help you to narrow the field that's out there. List the type of structure that you're looking. Are you an immediate sale, or do you want to stay on? Do you want a two-stage deal? How much are you going to want in compensation? What is your net? You'll have to tell them all of that. Some things are deal breakers. Location could be one. If you have real estate that you refuse to move out of because you own the building, well, that may not work with the successor firm. Partner retention, compensation, and items you feel strongly about, and this will all go in that cover letter. Maybe you're the one who's in the cloud and has everything virtual, and you don't want to merge with someone who's first doing it. Something that comes up a lot is the name of the new firm. A lot of sellers want their name in their firm, and you know, we can get around that. Sometimes we can put you on the stationery, a division of, But in a lot of cases, you're put in the name of the firm, and you know here in the state of Florida, it's so easy to change the name of the firm through SunViz, and you can keep it through the transition process, and then afterwards, you can go ahead and change it to something else, and associates or however you want to do it. You might be more flexible about software. Maybe the other firm has ProFX. You were thinking of changing to it, so you say, oh, all right, I'll learn it. It's okay. And perks. The fringe benefits are important to employees. They're important to partners in deals like this. There are certain things that you may want to look at. Had a client that said, I can only merge with someone who doesn't work on Fridays. And they work 10 hours a day for 4 days, and on Fridays, everybody's off for a 3-day weekend. Now, of course, in tax season, it's a little different, but they do that. That's a real perk. And that person's not going to want to merge with someone where all of a sudden they're told, I got to come in on Fridays? I'm not going to do that. So these are some of the things you have to look at. But what's really important is you look at the 4 C's, we call it. That's culture, chemistry, continuity, and capacity. Those 4 C's in a deal are so important. And I think, chemistry in any kind of dating, and look at this like a date, chemistry is really key to the success of what you do. Have your meetings, share what you want to do, focus on those 4 C's, discuss what you think the future is going to look like, and just narrow your choices of merger candidates. And as I said, ask for that non-binding offer. Just make sure everything you talked about is in there and there's no hang-ups from the beginning. Perform your due diligence. There's lists of what you should do, what you should look for in those firms. And these are some of the things that you'll want to ask of whether the buyer or seller, and then you can close the deal. At that time, we tell everybody, bring in the lawyers, okay? Because you've heard this before. Attorneys often break the deal. We want attorneys to make the deal versus breaking the deal. So have everything that you want in writing, discuss it with the other firm, and then go to the attorney. So it'll be easier for everybody. Now, some final other thoughts. Look at the chemistry between the parties, the continuity, culture of the relationships, so you can retain your clients, because you're going to be paid a portion of them, so you want them to be retained. Is there capacity to take over those roles that are being diminished, whether it's yours or your staff that may or may not have come with you? Always remember, a good deal is a fair deal. And remember, it's the package, not the individual variables. And can the staff get together? That's also important. In some of these, I had one where the successor firm offered to bus everybody over to the other side of town. This was a case of opening a satellite office from the east side to the west side of Fort Lauderdale. And they brought everybody over so that everybody would meet in the 2 offices, because there were going to be staff going to the west side as well as to the east side. So it's important that you have this with your people as well. And we have one final polling question, Nikki.
Okay, the polling question is on the screen. It's our 3rd and final one today. What is your greatest concern about succession planning? This time your options are yielding control, client retention, buyout terms, or other. We'll give everyone just a few more seconds to finish this. And then Marcia, it looks like we have time for just a couple of questions. I'll let you go ahead and start that while we're finishing the poll. You talked about what is on the seller's mind, but someone asked what thoughts are typically on the other firm's mind when proceeding with a merger?
Well, when we started out talking, I said one of the ways that we grow is through acquisition. And that would be the biggest thing on the buyer's mind. Something else that can, number 2 is acquiring a niche that they didn't have or developing something a little more strongly. Like I have one client who has a lot of banking and financial clients, and they wanted to merge with another firm that only had banking and financial clients so that they could grow that niche. They're known, and they will be known for that around the country. So those are the two key things that the buyer is looking for.
Okay, great, thanks. For the last polling question, 60% of the folks said the buyout terms is the greatest concern, 40% said yielding control.
Okay.
Okay, we have another question here. Once I agree to a successor for my firm, how much time will be in the process before the deal is done?
That varies, but as I said, once you started, get something down in writing, that non-binding memorandum, and make sure you're on the same page. If you are, we typically see these deals can close from 6 to 8 weeks. So it's a very fast process if you go through the steps as we suggest. But I want you to remember, there's a saying, time kills all deals. And that's why you want this process to go as quickly as possible. You want to show, whether you're the buyer or the seller, you want to show that this is your priority. This is important to you. You want to get this done because you're going to send a strong message to that other side. And you don't want any bad things to come out. A lot of you know Joel Sinkin, the president of this firm, tells a great story about tiramisu. Buyer and seller go to dinner, and after dinner, they both are arguing over the check, and then finally the seller says, no, 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 I'm going to take it. So then dessert comes, and tiramisu is the gourmet dessert at that restaurant. So the buyer says, oh, I'm going to have the tiramisu. I love that. And do me a favor, wrap it up for me. I'm going to take it home. So the seller's like flabbergasted. He's going to take home something for his wife. I finally agreed to pay for the bill, and I'm going to pay for that. The next morning, the seller called Joel and said, the deal is off. And he says, why? He says, that person waited till I agreed to pay for the bill, and then he puts another dessert on it for my wife. So time kills all deals. You got to be careful that something like that doesn't trigger a deal breaker. And you don't want to look at the agreements too many times. You want to know what's there. You want to revise it as soon as possible and get it to the attorneys and then start your transition. And that's the best advice I can give you on that question. I appreciate that you were all on this call today. Whatever your plans are, I wish you the best. I know some of you I've spoken to before, and I welcome you to email me or call to help you in your transition, and whether you're selling or whether you are acquiring to grow, I am there to help you. And please join Transition Advisors for some of these other very worthwhile seminars that we have, webinars that we have coming up. And I hope to see you all real soon. Have a great day.
Great. Thanks so much, Marcia. We'll go ahead and conclude now. And as I said before, be sure to wait before closing your browser. There will be a survey that pops up. It'll take you just a few moments to complete. Once you've done that, and assuming you did all the polling questions, then I will be sending your CPE certificates out to you next week. Thanks so much for attending.